I think this next panel really is a continuation of the previous couple of panels. I'm not sure where the distinction is between new entrants and competitive challenges and what we were just talking about in the last panel. So at the risk of maybe just a continuation rather than a new set of topics, seems to me the most fundamental challenging question in the sub-questions that were presented here is, does microfinance need MFIs? And so maybe a way to start this conversation, I'll just sort of start here and we'll go from Michael down. And getting to Paul's question a little earlier, trying to push on the investment side of it. We haven't talked too much on the investment side of it and what's attractive to investors. Imagine a world today that doesn't have any MFIs. We have sort of the fintech that's out there. We have big banks doing what they're doing. We have M-Pesa, it all exists. Would we want to create or recreate MFIs? And is the mold of the MFI sort of unique enough? What is it that investors would want to see in the MFI space that that hole would create? If we eliminated all the traditional MFIs that weren't these new entrants, what would we want to recreate? What are the unique features in that space that would attract investors?
Let me get at it, and if you permit, Todd, I'll answer it, but reformulate the question a little bit differently. Because I think what we're discussing is microfinance and the role that MFIs, as we know them, are playing and have played. And the question is, what relevance will it have in the future? So in order I think it's also important in this discussion, I felt it this morning, to sort of say, basically, what is microfinance? And let me present a very simple definition, which is financial services for the majority of a nation or a country, or the majority of the world, if you want. Because I think we run the danger of confusing methodologies and ways of getting those financial services, access to those financial services, with the field itself. And in that sense, let me first say that the microfinance institutions that's the catchphrase for, the catch term for the microfinance institutions that today represent the incumbents of the industry. The Banco Compartamos, the BRACs of this world, or the Bank Rakyat of Indonesia, etc., Grameen. There are many differences in how they deploy, but basically they're common, and they represent an approach to microfinance which is driven by loan officers with direct personal contact, and whether you deploy group loans or individual loans, it's a high-touch, high-cost method of delivery. It's been done great things, so what I'm going to say should not be interpreted as a slight to that. And some of you know that that's been a big part of my life. So that, to me, is the most successful vehicle that I know of that has delivered something that was supposed to address a need of the majority of the people that I know of. Some estimates put it at 100 million people reach. I think the reach is about 150 million. But I think you can also do some estimates that show that people that would benefit from receiving access to just the basic sort of working loan basic thing is about 500, 600 million in the world. Therefore, the penetration that we've achieved, even with 100, 150 million, is still about 25, 30% of penetration. But in the 4 decades that microfinance and that ended with this MFI model has been hugely successful, because I don't know of anything that reached 150 million people, etc. The reason why I don't think it's this model that's going to reach the remaining part is because this model has been so successful that we are basically at the tail end of reaching those people for whom the model is the perfect channel. And we're seeing that. Compartamos's growth rate is still in the 30s, but it's slowing down. It used to be in the 50s. And so what we have here is no criticism to the model. It's the model reaching the extent to what the sweet spot is. How are we going to reach the rest? Well, I think the things we're right now witnessing the disruption of microfinance. And the disruption comes through three things that have changed all our lives. So why wouldn't it change the lives of the poor or microfinance? And those three things are: one is the capability to process enormous amounts of data, more and more data, at lower and lower cost. And that is happening with a speed that's incredible. So now managing data that is truly, truly huge is very doable. The second is there is a way in which that data can go back and forth, and that's, of course, internet, at almost no cost. And the third trend is that we now have devices, handheld devices, smartphones, that can pull information out, that processed huge amount of data, and bring it to your hand, and from your hand it can upload to that stream of data. And that's changed all our worlds. That is beginning to change microfinance. And it's doing it in ways that upend the economics of the MFIs. So it's not, what would we do in a world without MFIs? I think we've seen a world of MFIs doing their stuff just as we saw in microfinance, the day in which it was all driven by NGOs. Because I remember that. And the big change was that we converted it into these MFIs as we know them today. Well, the day has come in which the MFIs are going to give way to these new models. And what are these new models? Let me give you some examples, because there's a lot of jargon, fintech, mobile banking, etc. M-Pesa is nothing more and nothing less, and the important thing is nothing less, because it's really important, than a payment system. What we're beginning to see is the application of all those three things to deliver microfinance in such a different way at the front end and at the back end that it actually ends up with very different economics. And that very different economics changes things that we take for granted and have taken for granted for decades. So for example, 2% default rate is where you ought to be, because if you have 10% default rate, you're sinking. Well, that's true if all the economics have remained the same. But if the economics are very different, you don't compensate 10% under this world by raising your rates. You just say 10% doesn't matter because my other costs have changed so significantly. So let me give you an example. I think we heard just in the last panel the largest MFI player in China. But actually, I think there's an institution in China that has disbursed in last year $10 billion. Creditees, not usually tied to, it's certainly not a traditional MFI. But creditees actually last year, November 2015, IPO'd one of its subsidiaries in the New York Stock Exchange, and that was Yirendai. What Yirendai does is it's the promise of going all the way from capturing client to dispersing and collecting all through the internet. Yirendai with a Y. So Yirendai. So what Yirendai does is it captures its clients from the internet. It has developed a capability that where it's going. I'll tell you the sort of end state, so you see the power. that within seconds, in a country rife with fraud, it will determine whether to lend or not. And how it will determine how to lend or not is actually by asking permission of the applicant if they can have access, like if they were that person in the internet. And apparently in China, maybe not in the US, but in China, everybody says yes. And what they do, what they go in is they go into platforms like Taobao, the e-commerce, and they scrape information of that person. And then they have algorithms that will determine yes or no, but in seconds. So basically, in about today, it still takes about 5 minutes, but the idea is to do it in a couple of seconds. No permission from the platforms, but they have the capability to do it. That's technical capability. And also, they have, from the past experience of credit ease, which has been going on for more than a decade, the data. And what you need to develop a good algorithm is the cases that worked and the cases that didn't work. And so it's from that mass of data that they've developed their algorithm. And that algorithm then, with data that they scrape, allows saying yes or no, and then it's a process of collection all the way through in which there is no human intervention. And that's what's so key, because for many times, and you heard it in the discussion this morning, it seems like personal touch is key. But let's remember how we developed that high personal touch. We developed the high personal touch because there was no other way to determine whether somebody was worthy of credit or not. That's how solidarity groups started. And as you reminded us, it is a high transaction process. So the minute that you can get it without a solidarity group, bang. And that's what competition does. That's why Banco Sol went from 95% solidarity groups to 1%. And that personal relationship, it was because we couldn't know whom to lend to or not. Then afterwards, the personal relationship developed, people became great friends. But it's important, I think, when we discuss the future, to be very clear and sort of pull apart all the things that emotionally, the reason why many of us were in this field, to get to the basics. And so those three things, and I could go into more examples, but are already disrupting. And by true disruption, of course, it's by having an economic model that upends totally the economics of the MFIs as we know it. And if the MFIs don't adapt, if there are groups that say, no, we can't get into that, it's so much investment, that's fine, because for a time, these systems will coexist. But there is no question in my mind that the disruption has already started, and we'll see in the next 5 years that accelerating. So, I have two hats. I'm at Harvard Business School, but I'm also the co-founder and managing director of a venture capital fund called Ignia that deploys in Mexico, looking for disrupting models that will be powerful enough to redefine industries or create new ones in the delivery of goods and services to the emerging middle class and low-income sectors. We're deploying Fund 2. Of the Fund 2, I think 80% of our investments have been in sort of quote-unquote fintech, which is nothing more than pulling together these three things in the application of goods and services for the people.
Challenging competitive environment from the point of view of an MFI trying to attract investors. Shannon, I don't know if you have some thoughts along those lines, or if you want to expand on stuff Michael brought up.
I want to expand a little bit on that, because I want to go back to the basics. Tim said that microfinance started off with credit because it was easy, and Michael says because it stepped into a market that was already existing in terms of these relatively low income, poor borrowers were already borrowing. But I want to point back to what I remember understanding about microfinance was a real innovation that solved the problem that all banking has, which is information asymmetries. And that every borrower is going to claim, I'm honest, I've got this great project that is sure to be able to go through, and that I'm going to work as hard as I can to make sure it happens. And the way that we've gotten around that, bankers gotten around that, first was collateral, but then in the Western banking system, we have collect background information, we set up these contracts that have requirements for reporting as well as for restricting behavior, and we have a court system that backs that up. And so those things were not available in the developing countries for people in poverty, et cetera. And so the innovation of microfinance was that it utilized social capital with groups. It also did progressive lending where you could get larger loans after you verified that you could handle smaller ones. And it came to the village level. It came down to where they were, in the neighborhoods, et cetera, and frequent and small payments. And so that was the innovation. I think that's why it actually took off, because it actually was solving a problem in a new way. And I think that Michael's correct in pointing out that we have another innovation that is getting around these same problems of information asymmetries with data. But so a lot of my perspective now comes from impact investing also, but it's very angel impact investing in social enterprises, very small startups. But there have been some interesting things I've come across. There is a company called Rex Mercury that is working in Kenya on education loans. And turns out the educational expenditures are huge in Kenya, 2.5% of GDP. And when a low-income family wants to make the payments for school, it's often not just from them, it's from a wider geographic family, and it might be quite distant. And so actually getting all those payments to the school at the beginning of the term can be difficult. And often what that means is they don't arrive there in time, and you've got a child sitting at home and losing out on that education until all those payments come in. And so his idea was, well, why don't we figure out a way to track all of this great information, that they have this network, and use that to provide them a loan so that they can actually get the kid into school at the beginning of the term and not miss all those days. And so they set up an organization or partnership, a couple of different organizations and with the schools, where that the family members could send their payments through M-Pesa to a special account, and Rex Mercury then would log and record those accounts, because M-Pesa doesn't share all that information, right? They've got all that stuff locked up. And so you talk about data, but a lot of it's locked up, especially with the payment systems that are mobile. But he was able to actually use Bitcoin technology and blockchain databases to validate the payments were made, and then those could be used for lending. What's interesting is they haven't even started the lending yet, but they've already had a huge impact, because it turns out that information, the fact that these payments have been made, isn't something that schools are actually very good at tracking. And so being able to provide the family, say, look, here's the list of all the payments were made, they can go into the school and show it to them, that actually is what was getting the kids into school. And so it's not just having all that data out there, but how are we going to use it and where is it needed, that I think can be important. And so in terms of where is the money going to go, so it's not just having, algorithms are great, but I think there's also many different ways you can use information and data that I think will be important as well.
Great. So I'm going to keep pushing on the investor angle. Nobody wants to invest in MFIs. Neither of these guys have MFIs in mind. You do.
People do. People do. Compartamos Banco is in the Dow Jones of the Mexican Stock Exchange. It has a market cap of $3 billion, and people are trading in and out of Compartamos shares actively. So people are investing. People are investing in successful MFIs. I think looking into the long distance, it's a good question. It was one of the Charlies, Carlos Lanel, who said, we don't want to be the Kodak of microfinance. And what he was thinking about was exactly how does a winner big institution like Compartamos deal with this? that is coming in the horizon.
By the way, we desperately tried to get them to come up, but they had a conflict, so they tried.
So, Ami, you want to sort of, in your comments before, you talked about sort of this difference in your own sort of world of finca, the MFI side and this other stuff you're doing. Is the MFI side necessary for the second? How does that bridge work from the point of view of, one of the more successful microfinance organizations worldwide?
No, it's a great question. So as you had asked that question, I interpreted it to say, and we have, so I work at Finca, which is an MFI. So I hope that we don't become the Kodak.
I used to work at Kodak, so
for self-preservation reasons as well
I
as
left
pride
Kodak
of
and it went
place.
downhill after I left. That's what happened.
So from that perspective, as well as from the perspective of some of our investors are in this room, and so I want to be careful. But so I want to be careful from that perspective as well. But if your question is, should the IFC continue to be long on Finca, or should the IFC continue, go long on another company? I think that is the question, right? I can tell you from my perspective, biased as it may be, but let's talk about some of the innovations in the space, right? Or let's talk about the innovations in the context of the things that Finca is onboarding in the microfinance space. And then happy to talk about it in the Finca International arena, which is where I sit, in fact. But so our... I forget the aphorism, so I will be not as articulate. But there's an aphorism or an adage that says if you're not moving, you're dying, right? And so I think there is absolutely a call and a mandate for all institutions to grow and to continue to evolve, and I think that is true for any business. And the way that Finca is evolving is through 4 major initiatives on the microfinance side. One is agency banking, which I'm sure many of you are familiar with. The other is mobile financial services, credit scoring, and then digital financial automation. Digital field automation. So if I talk about credit scoring, we partnered with a vendor who is a early stage credit scoring company that sort of said, yeah, exactly. We will use M&O data, and there is such a wealth of data. We'll be able to provide you with new customers, new ways of looking at information, and improve your ability to do loans. What we've learned is that it's much more complicated than that. Having historical longitudinal data, enterprise data from our own databases is actually the most indicative. And then this additional data is additive, but it is not going to, at least in our experience, it doesn't replace the longitudinal data we have on our customers and the wisdom that comes from that. So if you were to go long on a business that just uses M&O data and says, we're going to create a credit platform for that, that's wonderful. But yeah, have you looked at sort of PAR, and have you looked at PAR when a macroeconomic crisis hits? And so one of the things that we talk about is that, so you have growth, you have scale, but then you have survival after scale, and the things that are requisite for survival. If I talk about agency banking, we see agency banking as, one of the things that I did, because I am new to the microfinance space, when I joined Finca, I actually ended up spending time in 2 of our subsidiaries and helping write their business plans. It was just a very fast way for me to onboard and really get to know the regions and the businesses. And so I got to see everything with fresh eyes. And it was a country that we had just launched agency banking in. We had, previous to that, in the 5 years previous, actually opened up branches. We had put a lot of effort into those branches. And the idea was that one of the things that, for customers, coming to Finca is like we're one of the few organizations, we believe, that serves low-income populations with the kind of respect and dignity we think they deserve. And one of the things that really makes them feel like they are part of a formal sector is the ability to walk into a branch. And there's real value in that, and we put a modest and a smart amount of money into building branches. The challenge is that once you launch agency banking, it actually changes the throughput in your branches. And so the question becomes, how do you manage, that kind of investment? So for us, agency banking is really about the day-to-day transactions that, in order to pay loans, to ask questions, to confirm deposits, things like that. But the branch doesn't get replaced. The branch just becomes a different kind of platform. It's a place where you go for financial advice. And so one of the things we're thinking about is now, how do we actually use that in a different kind of way? And where does it now no longer may need to sit as a larger footprint in a very active area. It can maybe sit as a smaller footprint in a place that may have a little more prestige in that area, where you come in to get financial advice. So as we launch some of these new things, we're seeing a change in how we use our existing infrastructure. And then I'll wrap up. And then mobile financial services. So we're launching with things like push-pull, so where you can actually just see what your bank account balances are, et cetera. We're bringing on mobile savings and mobile credit. And all of these things, when I was learning about them, I like to organize things in frameworks and buckets. And so I was like, how do you guys think about all the different initiatives that you're bringing on? And there is two ways that we look at it. So we put customer experience at the center of the way we think about everything we do. So how does it solve a problem for the customer? Then the second ring, if you think about it in concentric circles, is how all of these initiatives actually reduce cost. Right, so many of these things are operational and have the potential to reduce costs by up to 30 to 40%. But then once you build out this new infrastructure, it's a way to create new products, and some of those we may copycat off of off of some of the innovators. Some of them we may actually partner with innovators on. But I think there was an article that was shared. And it's part of the homework, what is the future of banking? I mean, I think we still believe that it's banks, but I don't think it's banks in the way that they existed even 5 years ago. But that's our perspective.
Claudio, you're coming from BBVA. BBVA has made enormous investments, big bets on MFIs. You've bought a bunch of them. So you clearly believe there's value there. What is that value? And, is there a difference between BBVA as a bank and the MFI part of it?
Your question gives me an opportunity to clarify something, and also a place to start on my conversation. One thing is the BBVA bank or financial group, and an entirely different thing is the BBVA Microfinance Foundation, which I represent here today. And why is this distinction important? And why this contradicts some statements that are made about big banks going into microfinance and the BBVA being an example of that? It's exactly the opposite. The bank did not want to go into this sector. The one understood and recognized that it could not do it at a cost that was reasonable, that it didn't have the kinds of skills and approaches that were needed for this, that it could not operate in a competitive banking environment where interest rates, either with ceilings or without ceilings, have some notions of what a natural interest rate would be, and you cannot do microfinance by charging 5% per year. So the bank said, we will not do microfinance. And then at some point, and as part of the social responsibility strategy of the bank, they said, but there are lots of intangible assets that we have in the financial sector that could be inherited by some who would do microfinance. And they created the foundation. And the foundation is very much an experiment, sort of in this process of evolution between a bank, where BBVA as a bank, as a financial group, is at the forefront of the digital revolution, investing in lots of these areas, and a microfinance group, because what the foundation does is it acquires and manages a number of microfinance institutions in Latin America, a microfinance group that is trying to resolve what we believe is a central challenge of microfinance. It's trying to resolve how to keep some of the reasons that make microfinance successful, and there are the raison d'etre, and at the same time incorporate the new technologies from information and communications and so on and so forth. So to get there, let me start by saying something. We see the group as a factory of relationships. We don't see, and this is very important, because a lot of the conversation this morning has focused on specific transactions. Do I have a loan for higher education? Or do I have insurance for a home? Or do I have, and this is looking at specific transactions and specific ways of delivering these particular transactions in a separate way, which has a number of disadvantages. On the one hand, at the macroeconomic level, it destroys the process of financial intermediation, which is so central for the efficiency of the economy, where you have deposit takers transferring funds, purchasing power through loans in specific ways. This is the macro idea that financial deepening leads to better allocation of resources and so on and so forth. If we had a multitude of providers of small separate transactions, you destroy the process of financial intermediation in the economy. And very much the same thing happens at the client level. I think that it is true, Michael, that creating a relationship was a way of solving the information issues and incentive issues that banks could not resolve. But at the same time, these relationships created extra value. They created social capital, they created trust, they created interest in the fulfillment of contracts, they made longer the horizons of people, because people will engage in these relationships because they thought that these would be long-term relationships where the structure of incentives was embodied precisely in my perception that this is a valuable relationship that is going to last. So this lengthening of horizons, this social capital, this trust that was being created, all of this is extra value that is created by the relationship that has not been, will not be created by these specialty transactions here and there all over the map. So we went into microfinance then with this very strong conviction that relationships matter, and that they matter a lot, and that there is a need to make every effort to sustain these relationships. And we also wanted to continue addressing the information issues of the past, because as we are expanding, we're still encountering a huge clientele that is looking for this kind of an approach. In Peru, it is not in Lima, obviously. But we are not growing in Lima. We don't want to grow in Lima. We're going to La Selva, to La Cordillera, whatever, to Manaus, and the rest. And there is this paradox of tremendous saturation and over-indebtedness and so on in some places, an absolute lack of access to institutional finance in many, many places, particularly in remote rural areas and so on. And of course, it is going to be harder to reach these more remote, distant places with a relationship, but still is the only way we will be able to do it. So what are some of the things that we value in trying to develop our business model? Proximity, heterogeneity, and efficiency. Proximity means not only that we have lowered the costs of getting where they are, but also and particularly that we are lowering the transaction costs for the clients, and we'll see how that can be done. Heterogeneity, because if there is one thing that I could say about the clienteles of microfinance, at least in Latin America, is that each individual client is tremendously diverse. There is incredible variation in demographic conditions, in skills, in experience, in preferences, in dreams, in whatever. And following your reference to institutional financial theory, asymmetric information, moral hazard that result in uniform contracts in pooling equilibria are extremely inefficient. And if we really want to solve the financial issue for these people and give them something that is truly valuable for them, we have to start by recognizing these differences. And these differences may show up in big data, may not show up in big data, because some of these differences have to do with all kinds of intangibles, attitudes, creativity, honesty, willingness to work, and of course, their ability to create a history. And we looked at what we could do, and there are two kinds of errors that one can make in doing finance. One could make a loan, give a loan to someone who will not repay, and then the price, the cost is you will have default and delinquency. But there is another error, and the other error is to deny a loan to someone who had the ability and willingness to repay simply because of my own ignorance, my inability to see it, my inability to perceive that. So we are very concerned about this, and therefore we are very concerned about who are being excluded in different scenarios. And here, there is one other thing, two things that perhaps I should say. One is that any innovation, no matter what, always includes some and excludes others. And you can see that. What did mortgage lending do? It included people with real estate and excluded those who were not proprietors. What does credit scoring do? It includes those that fit a particular statistical profile. What does credit bureaus do? It includes those who already have a history. But we are precisely interested in those without history, that do not fill the statistical profiles, that do not have the traditional collateral, and the only way, and there are hundreds of thousands of those all over the developing world, the only way of knowing that is through proximity, getting close to them, observing them, learning with them and from them over time through this human interaction. And understanding the differences and trying to understand what will really be valuable for them and not. So how do we do this? And I will add. We are trying to do this by first recognizing that the new dimensions of exclusion are going to come from lack of connectivity. And people can tell me, yeah, but they all have phones and so on and so forth. But I sit in my desk in La Paz, Bolivia, bumping on the table 3-4 times a day when my Skype conversation gone, I lost a girlfriend, and so on and so forth. Then affordability. It costs in Bolivia, let's say, a reasonable data plan, $30 a month. Okay? This is $1 a day. For people who live with $3 a day, spending $1 a day on connectivity, that is going to be very expensive. It's going to improve over time, but there are a number of other issues. And culture. And this is people who have fears, people who need to develop trust, people who lose this trust if one day their payment system in Africa goes off and blackout, okay? And then they are very scared. And there are the illiterate women in the Peruvian or the Bolivian highlands that cannot text because they don't know how to read or write unless you have then a special sort of things. But there is the financial literacy, there is the digital literacy, which I am part of that generation. I never played Nintendo. I feel completely excluded from all of this conversation. And then a recognition that there is going to be a demographic wave. Okay, so right now, these people that I am describing are at the core of our clientele, but they will be getting older, and the younger children of them will be coming in, and so on and so forth. So that this is not going to be immediate. This is going to be a gradual process as this demographic transition plays out and as the infrastructure in the different countries is developed, and so on and so forth. So we said, the client is in the center of what we want to do, but we are not going to start by digitalizing the client. We are going to start by asking ourselves, do we have our house in order? Can we make our processes leaner? How can we bring in all kinds of applications and information systems and so on, so that we can manage better our information, lower the costs of the back office, and so on? Can we install sort of a bank total system that allows us through the group to exchange information and so on? One thing that we do that I will perhaps mention here later is that we're very interested in measuring results. And we have this extraordinary longitudinal panel of all of our clients over these years now that we are using for all kinds of purposes. And so we will do that. Then will come mobility. You will be surprised that even loan officers are reluctant to use some of this technology as well. So we need to adapt them to this. And what we are doing in a number of places already is that we don't want to lose the personal contact, but the loan officer in some areas of Peru, some areas of Colombia, in some of our institutions in the Dominican Republic, not with a tablet, but with a cellular phone, the loan officer goes to visit a client, okay, and he brings this tablet. And in this tablet, he has the whole history of the client, everything that he has done with the institution. It has all of the information about climatic predictions, prices, value chains, where the input suppliers are located, what is the distance, and this and this and that. And then he sits down with that household, and this is another dimension of microfinance. One of the central innovations of microfinance was the idea that the unit of analysis is the household firm, is that integrity of a household and an enterprise or a farm that are not separate, is not a project like in the development banking, is not a particular transaction like in a credit card, is this unit. So let's sit down, let's see what are all of the flows of cash and so on and so forth, issues from your household, and he's keying in all of this information, which is the information that we then use in our longitudinal study precisely to follow the clients. And then we have programs, algorithms that take all of this information and now tell him, we can give this borrower so much within this range, and this range, you evaluate some of this other intangible sort of soft information. And if you do this, this is what the repayment amortization pattern should look for this borrower. So if this guy is raising llamas, when is he selling the llamas? What are the fair times? If this guy is growing potatoes, when it's planting time, then you will be repaying very little. When it is harvest time, then you will be repaying a lot. And it does this contract profile for every client individually, because all of these are very diversified households that have a number of agricultural, non-agricultural, livestock, and so on and so forth activities. So if we manage to do this, we accomplish two things. We are using the information we get from the client, the information we have from value chains, the information from the environment, and the individual characteristics of that client that has specific patterns of cash flows over time and so on. And we are designing a contract that is for him. And there will be conversation about other products. Cross-selling is very difficult, I agree, but there may be some interest there. And there is a little printer that comes along. You print that contract, the guy signs, and you go back. So through this, and eventually by doing this with our agents, and we want to develop a network of our own agents. We don't want to use third-party agents because we cannot do then the kind of training that is needed. We will be able to accomplish first, as close as possible, branchless activity, and leave cashless activity for as the last step. Because the issue of moving cash around, you'll be surprised. You can have all of the technology in the world, but moving cash around is very hard. And but eventually, this same client that has had this visit and that will be visited regularly will have a phone where she can make repayments and manage the deposit account and so on and so forth. And eventually, our last sort of hope is that we will develop communities, kind of internal Facebooks among clients where they can interact among themselves, they can ask questions, they can receive financial or other kinds of education, news about El Niño Costero or whatever and so on. So the message is, if the development of personalized relationships disappears, we would have lost the most substantial and important contribution of microfinance that made it such a tremendous revolution in the history of finance. And that will be a tremendous pity. It might happen because some of these organizations might not be able to compete with these new entrants that are eating away parts of the market, and then what you are left with is sort of some fragment.
So let me see if we can
so if
bring
we
some
do
of the
that, so
conversations to
technology should be a complement to strengthen and reinforce the relationship, not a substitute of relationships. That's what we are betting on at the foundation.
Great, thank you. And I think the last comment about all the competition that's out there is a great opportunity to see if you have some thoughts from the crowd about these new entrants and the effect, especially from the investment point of view, which is kind of one of the main points of this panel. Those of you who are our investors, maybe Paul, you could talk a little bit about what you're looking for from a social impact investment point of view that MFIs, what's still attractive about them from an investor, a social impact investor point of view, or others of you who have that kind of viewpoint.
Well, there are other investors here who could chime in. We do a lot of equity investing, and I would say that we feel that there's lots of niches still to be exploited, but with expectations, reasonable expectations for what that means for equity investors. So, we've found that, the returns that we were all quite comfortable projecting, 6 or 8 years ago, we would not be talking about those returns now, and whether, there's going to be a meeting between the providers of capital and the opportunities that we think are available, really remains to be seen. But, in terms of, if we have the capital that comes in with reasonable expectations, I think a lot of the things that have been discussed today, institutions that focus on, particular populations that are perhaps remote or for some other reason underserved, or institutions that are bundling together, serving as conveners or as channels for providing other types of services that can meet a need on the part of the clients. I think there are lots of those niches that are available for relatively small investors like ourselves to exploit. But I think that the supply of capital that's comfortable with those kinds of investment propositions, I think, is a big question.
I think, Paul, what you're referring to is precisely the great success of microfinance. That in this 4 decades in which we created the MFIs of today, the big lesson for me is to have taken something that began trying to help provide something that people needed much better into something in which it is now the conventional capital markets that are providing the major funding. Microfinance, meaning the microfinance institutions that we're talking about, no longer need us. That's the comment that started this, saying, yes, microfinance in that sense is dead, but like Damon said, it's dead for donors. And it's dead for people who are thinking of how can they impact something new. So the need for a capital that wants to have impact, doing things that are really innovative, either reaching markets in a different way or changing the economics of what is being done, I think is precisely that. If you do just invest in microfinance, for example, if you go and buy Compartamos shares, that has nothing to, you're just participating in a commercial market. So that's, I think, the great success. We made it mainstream.
Do you think that the commercial market will continue to fund the high touch components that are going to be required for the microfinance industry to continue to evolve and add products and do a lot of the things that you're talking about? I mean, like, do you have enough funding? Is there resources out there to continue that level of growth? And where do you see those channels developing, or what challenges have you faced?
That is a very good question, and I'm going to answer part of it, and then I'm going to ask actually Momina to talk about what she's doing with Finca in the DRC, if that's okay. No, I think so. One of our challenges is that there is this acknowledgement and now expectation that microfinance is stabilized and it is sustainable, and so commercial capital should now be the primary source of capital for the business. But the challenge is commercial capital came into, so in my view, for Finca, it took 20 years to build up a business that then commercial capital came in to expand the balance sheet for. Then technology has upended the way that finance can be delivered, creating, I think, competitive pressure, as well as, really competitive pressure. And so then there is a recognition on our part, well, we need to really reinvest into the business. But we operate in very tough markets. And so what happens is part of the network is profitable, other parts aren't profitable. Overall, the business is sustainable, but we don't necessarily always throw off excess proceeds to say, oh, wow, this income, now we can use that to go fund DFA across digital field automation across Africa. But so who's going to step up to do that? Because folks are happy to fund balance sheet expansion. They are not happy to fund the projects that will take another 5 years to actually hit break even to then be attractive to equity and debt. So that's what we struggle with. And I do think organizations like Finca should continue to be funded by a blend of capital. I don't think that the innovation funding that comes from aid and those sorts of institutions should only go to the innovators, because we're innovating the scale, if not the technology.
Thank you. So, I mean, I'd like Roland also to step in here, help me from the investor side. So, I'm not sure whether, we're talking about microfinance as a really evolved industry, and yes, there is one compartamos but for one compartamos, there are about 300 which are not sustainable. We've invested debt and equity in the holding companies, in retail MFIs and banks. What we're seeing is that the ones who have done better are the ones which are stronger institutions, well-governed, have strong risk management. There are not that many of those out there actually having gone through this experience. Country risk still remains a huge issue. Even in the last month, we've had huge issues with MFIs in Nigeria, in Cambodia now with the interest rate caps, macroeconomic crises. In the past, we used to talk about, MFIs were resilient during macroeconomic crises, and that, we survived, and that's no longer the case. We're seeing that very much so in places like Azerbaijan, in Nigeria, where entire business models are collapsing because MFIs have, A, there's a macroeconomic shock. B, some of these small lenders small businesses are also reliant on export-based models, the MSMEs. And third, the credit risk function is not as evolved as it should have been, right, in these MFIs. And governance still does have a huge role to play in that, especially in a lot of the traditional NGO type models. But so, from the investor side, these are some of the things which are quite frustrating because the industry has developed over the last 2 decades, but we're still dealing with, issues that normally do not exist to that extent with mature models, things like governance or, sustainability. And yes, it's true. I don't think there is that much donor appetite or patience to resolve issues like that. We just done this huge program with Boulder where we had 100 MFI CEOs come together and focus on risk. And, 2 or 3 of the biggest risks that most MFIs were facing was changing strategy, governance, and credit risk, which were things that we've been talking about for many, many years. Even as an investor, it is, some of those challenges have been around for a long time, and I'm not sure whether the MFI sector has truly evolved, to to face some of those challenges.
Sure. Well, you passed me the mic. I'm happy to comment. Well, and I think we're, thanks to the panel, to all of you panelists, because it's we're right at the center of our discussion, and it's super interesting. We're actually a lender, so we have a bit of a different perspective. But it's true. We ask ourselves the question all the time, in a sense, who are the equity investors and what are they doing? And so it was extremely interesting to listen to you, Michael, and to you, Claudio, because on one hand, you have a tendency to say, let's drop the MFIs and invest in this new digital stuff. And on the other side, there's a tendency of saying, well, let's try to fix the MFIs and improve them. And as lenders, of course, we would expect it's the second model that picks up, because otherwise there's a tendency that we're just letting these MFIs sort of drift away, and we're betting on something new. And so my question to the equity investors, and maybe it's for the next panel if we're at the end, but it's really having a discussion on, there was an entrepreneurial spirit, I think, at the beginning that drove a lot of innovation in the MFIs. And do we need to ask ourselves or wonder maybe if the current shareholders of the MFIs are not innovative enough? I don't think it's a question of we need more subsidy. I think we can find capital that will take that risk on a long-term basis. But what does it take to reboost those equity investors to essentially transform our MFIs like they did in the past? They transformed the MFIs from NGOs to banks. How can they transform them from banks to digital? I don't know what the word is. We'll maybe discover it later on.
May I? What you're pointing to is a very general problem, which is can incumbent winners be the source of the next disruption? Historically, they have not. That's why Kodak invented digital photography, but is no longer with us. That's why Barnes & Noble sold books, and Amazon didn't generate the Amazon. So actually, the 3 trends that I talked about can be used in two ways. Claudio is absolutely right. There's a lot of improvement to the existing model that continues to take place. And those are changes that improve and make more efficient the current model. Or you can use the three trends that I'm discussing to build a different disruptive model. Both things will take place. And I think, in my view, that disruption has already started, and it'll be very difficult. This is one of the dilemmas that Compartamos is addressing frontally. Can a dominant in the industry today be the source of the disruption of tomorrow? Because the elements are all there. It is going to be disrupted.
If I were a different kind of an investor, I will realize that there are a number of disruptions. There is a whole range of potential disruptions and also a whole range of improvements in the incumbents. And we live in a world of tremendous uncertainty. Change is happening very rapidly. All of this is extremely complex. I will never put all of my eggs in one single basket. If I were an investor, I will choose some mixture of incumbents, some of the promising disruptors, and so on and so forth. Little bits and here, not marry myself to just one single approach.